Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus, and today we are going to talk about tax advantage savings of investing in real estate. Quick disclaimer, though, before we dive in, remember episode is for educational purposes only, and it's not a substitute for professional tax advice. Be sure to consult a tax professional to address your specific needs. So today we're exploring something every high-income earner should know about, and that's how real estate syndications can help lower your tax burden. This episode will explain how tax benefits like depreciation and bonus depreciation works, as well as touching on the benefits of real estate professional status. So let's jump in and see how syndications can give you an edge. So depreciation, what is depreciation and its impacts on returns? Let's start here with the biggest tax advantage, which is depreciation. It allows you to deduct the value of wear and tear on a property over time. And even if you're not managing the property directly, you can benefit from depreciation as a limited partner in a syndication. So basically, in the eyes of the IRS, over time, a building wears out and thus can be depreciated back down to zero. Now, at the time, you can take this depreciation, or what's considered a loss of value of the building, over time, and this goes against the tax burden. The cool thing about this is even if the building's been fully depreciated by a previous owner, when you buy it, it starts all over again. And it's not that the IRS doesn't understand how this works. They've left these benefits in for reasons that make real estate a valuable asset so that people will want to own it, because people need places to live. People need offices to work in. People need places to run businesses. And so that's why these things exist. So an example of how depreciation works in a syndication is, imagine a syndication generating $10,000 of cash flow annually. With depreciation, when that depreciation passes through to the investor, you might only have to report $6,000 of that as taxable income. So you keep more of the money that you've earned. This deduction means you're essentially creating tax-free cash flow, which is a game changer for high-income earners. This is different from investing in the stock market. If you have a good, like blue chip stock that's spitting off dividends, you still pay taxes on those dividends. Now, there are things that people do, and there's lots of things that can be done, but those don't get treated the same as money that comes out of real estate with depreciation. So now, bonus depreciation and cost segregation. This has changed and been a lot of talk over the last few years, because the rules for bonus depreciation and cost segregation have changed slightly. So what are these, and what do these big words mean? So what they essentially allow you to do is front load your deductions, so you get a larger tax benefit in the earlier years. So cost segregation goes through and says that we're going to take the stuff in the building, and we're going to segregate them out. We're going to divide them out, and that some of those things that wear out faster can be depreciated faster, versus the building lasts longer, but things in the building like carpet and drapery or blinds, those things wear out faster. So by saying, okay, these things wear out faster, we can depreciate them much faster, which moves more of the depreciation to the front end of the investment. And bonus depreciation is just a way to push even more of that forward. We've got some great episodes pretty early on with Isaac that talk about this in more detail, and it can be kind of a complex thing to understand in the beginning. But the point of it is what they do is by allowing you to front load your depreciation, if you're not planning on owning the investment for 30 years, um, is you can get a lot of those benefits up front. And a lot of syndications have a hold time of, say, 5 years. Well, if you're able to push all those depreciation benefits to the front end, you may pay no taxes on that cash flow. So back to the original example, you have a syndication generating $10,000 of cash flow annually. With your cost segregation and bonus depreciation, you may pay no income tax on that money that's coming out. So now it becomes untaxed income. And the cool thing about that is compared to other assets is you can move this all up to the front. And it's one of the few places you can now put your money to work for you and not pay taxes on the money that it generates. Now, there's some more complexity to this, but that kind of moves us on to 1031 exchanges. What are a 1031 exchange? Now, 1031 gets even more complex, and sometimes, unless things are set up appropriately, you might not be able to do it. But what a 1031 exchange is if you sell a property and you sell it for more than you paid for it, so you have a profit, you reinvest that into a property that qualifies. And that's the 1031 exchange. So you don't pay taxes. If you bought a building for $50,000, you sold the building for $100,000, and now you invest that $100,000 in another building that qualifies, you don't have to pay taxes. And you're basically pushing those taxes down the road. And with all of these, with depreciation, there can be down the road tax implications. And what they call that is depreciation recapture. So you depreciate this building down and then you sell it later. There is a possibility that then at the time of sale, that depreciation gets recaptured and you have to pay those taxes back down the road. Now, this is a key point in having an accountant who understands investing in syndications and investing in real estate, so they know how to handle things that you avoid this depreciation recapture. And one of these is something like a 1031. So the 1031, again, you've just pushed off paying the taxes on that. Again, you bought it for 50,000, sold it for 100,000. So you made $50,000. You move the whole 100,000 into a new investment through a 1031 exchange. That doesn't completely go away. You've just pushed it back. But what a lot of people talk about this with building a legacy is that you can keep pushing this back until you die and you put it in a trust. And then the people who inherited a new basis. So if you started that $50,000 and you do this over, 30 years, that $50,000 may be $1 million. If that $1 million is left in your estate and the estate is planned properly, your kids are going to inherit the $1 million as $1 million, and all those taxes over the course of your lifetime when you grew it go away. And that's kind of a lot of the real estate game is put the taxes off potentially for forever, or it could be you have a year that, say, you quit working, or you get sick and you don't work as much as a doctor, and you lose a bunch of your income. Well, then all of a sudden, that's not such a bad thing. You come back, and during that year that you have a much lower income, maybe you let some of your built up depreciation go, and you can roll this back in as income and pay the taxes on it a year that you've got a lower income. Or if you had some other big tax saving event, you can bring that income forward then in a better tax year. And there's part of, like I said, having a really good tax professional who knows how to handle these things and can help you build a strategy for how to do it. So it can actually be part of a plan that I know. I want to take this huge vacation with my family. We've been talking about, well, I'm going to take 2 months off and we're going to travel around the world. Well, you may say, well, we're going to do this big trip in 5 years. So we're going to plan these other tax events around that year when your income's going to be lower potentially. All right. And so the last one I want to talk about today is the idea of a real estate professional. So real estate professional status, or you'll see it referred to as an acronym as REP, requires more active involvement. So if you're just a passive investor in syndications, doesn't work. And basically, like I said, check with your tax professional and make sure you get it right, is saying that you've devoted half of your working time or half of your income essentially came from real estate. So as a surgeon or as a doctor, this can be really hard to do because you're working a lot as a doctor. Now, the great place for this is if you have a spouse who either works minimally or is a stay-at-home spouse. And what that can mean is if they can do the real estate work and have that real estate professional status, then you file your taxes jointly. And if you have a bunch of depreciation, so let's say you invest $100,000, that $100,000 generates $10,000 in cash flow. But because of your cost segregation and bonus depreciation, you can deduct $30,000 in the first year. So that $30,000 wipes out the $10,000 of cash flow, but you got $20,000 left over. Well, now if your spouse has real estate professional status, that extra $20,000 can be deducted directly against your income as a surgeon. And so this can be a really powerful tool, especially as you build up a bigger real estate portfolio. Now, again, it's one you want to make sure you have an accountant who understands real estate professional status, understands depreciation, cost segregation, bonus depreciation, all these things, so they can set it up and do it right and make sure that all the boxes are checked, that you actually qualify for real estate professional status. All right. So those are really the big four. Now, if you're not doing those big four, then, and you're looking at, and somebody you've heard about all these other things, go back to the big four and make sure you've at least checked those boxes. And if you're investing passively in syndications, here's another question you want to ask the sponsor. Say, how do you handle depreciation, cost segregation, bonus depreciation? Because depending on how the syndication is set up, that may not flow through to the limited partners. So you want to make sure it's set up that depreciation is going to flow through to the limited partners, at least to the extent of cash flow you're going to have back out of the syndication every year, so that cash flow comes out tax-free. So that's an important thing to ask when you're going through this, because a lot of people don't ask, and the syndicator may keep all of that for themselves and be using it to set off their income kind of at the expense of their investors. Now, there's nothing wrong with doing that if they're honest about that's the way this is set up. But you want to know what happens to the depreciation, because as a limited partner, you are an owner and you have a right to have some tax benefits from depreciation. So this is going to be my first attempt at social media engagement with the podcast. So here we go. What I would love to know is, what would be the most important tax benefit you would like to learn more about? Would it be depreciation, including cost segregation and bonus depreciation? Would it be 1031 exchanges? Or would it be a way of taking passive losses and putting those against active income? So share that on social media, and we'll see if we can dive into that further. This will be the topic of one of our upcoming webinars, which will give you a chance, if you want to attend the webinar, to ask these questions in person and learn more. So that's it for today's episodes on tax benefits and real estate syndications. Remember that syndications are one of the few investments that offer a powerful combination of cash flow and tax savings, and especially for high income earners. And remember, this is not tax advice. This is all educational. Make sure you find yourself a good tax professional out there who knows how to handle these things. I can make some recommendations. If you'd like, reach out and we can do that. So until next time, thank you for joining us here on Surgeon Syndicate, and we'll see you then.
Do you care about paying too much in taxes? And would you like to save more of your hard-earned dollars? Here's what we found. We found that most financial professionals have a one-size-fits-all solution. So the question is, would it make it easier for you to have someone tailor your tax solutions to your individual needs so you can keep more of your money and do what you want with it? That is exactly what we do at 𝐥𝐸𝐿.
As surgeons, we know the difference between routine surgery versus life-threatening interventions. And I want you to know that I've used 𝐲𝐻𝐸 and her team for my personal financial intervention, and I love the results. I would do you a disservice if I didn't recommend them to you.
We'd love to help you, so let's jump on a call and see how we can collaborate. Simply go to www.𝐥𝐸𝐿stra.com/McManus and book your free call today.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.